Good day, subscribers. Thank you so much for joining me today on the Financial Education channel. So today we're talking about what is a mutual fund. A mutual fund is money that is pooled together by regular investors, so it can be anybody, and that money is managed professionally by a few managers and a lot of researchers. And basically what their goal is to get you a good return on your investment. Now, you buy shares in a mutual fund. So if the shares of a certain mutual fund are $50 a share and you have $100 to spend, you're going to be able to buy 2 shares. And those shares will go up or down in price as a percent, the same percent that they can get as a return on investment. Now, if they get a 5% return, your shares in that mutual fund might only go up 4% or so because they take out money because they got to pay themselves and whatnot. So if they get a 5% return, you might only see a 4% return on your shares of that mutual fund. Now, a mutual fund is only basically trying to get the same percentage return as the stock market is doing, the S&P 500 or whatever other benchmark they're using. Could be the Dow 30. A lot of times it's the S&P 500, most cases. Sometimes it's the Russell 2000. So if the S&P 500 goes up 8%, that mutual fund, all they're basically trying to do is also get an 8% return. So they're not necessarily trying to beat it or look extraordinary. If they do, that's great. But basically they're just trying to do as good as the market's doing. That's where it differs from like a hedge fund, where a hedge fund is taking a lot more risk and they're trying to get better returns than what the market's getting. So a hedge fund manager is really trying to outdo the market and really trying to beat it easily. That way they can look extra good, but at the same time, sometimes they can fail horribly because they take a lot more risk and they go a lot bigger into some companies and whatnot. Whereas the mutual fund's really diversified. They really spread their money around. That way, like I said, they're just trying to do as good as the market does or as bad as the market does. So if the market goes down 8%, they want to go down 8% as well. They don't want to go down 15% or 20%. Whereas a hedge fund may actually do that. So that is the basics of what a mutual fund is. If you have shares, if you have a 401k at your workplace, they're probably invested in a mutual fund of some kind. And so basically your money just does as good as the market's doing and whatnot. So that's a mutual fund. Thank you so much for watching, guys. Subscribe if you like this, thumb it up. If you haven't subscribed, you may want to. I'm just trying to lift everybody's financial education up one day at a time. Thank you, guys. Have a great day.